If you don't understand where the liquidity is in the marketplace, you will be the liquidity in the market. These are the trades I took this week and made 15% account gain in a single week. If you understand the liquidity, you will also take this type of moves. It's very, very easy. The trading will be, if you once understand the liquidity, you will make tons of money. So in this video, I will exactly explain the liquidity concepts in a simplified way. These are the 7 different types of important liquidities in the forex market. By understanding the liquidities in the marketplace, you can exactly tell where the money is in the marketplace and from when the movement will occur. So the first important liquidity is the previous day's external liquidity, and second one is previous day's internal liquidity, third one is structural liquidity, transactional liquidity, inducement liquidity, and news highs and news lows and daily liquidities. I will explain each and everything in detail in this video. So watch this video till the end so that you won't get any doubts or confusion. So let's start the video. What is the previous day's external liquidity? The market normally moves like this. Let's say this is the price range. This is the previous day. Let's assume this is the previous day. And same thing here. When coming into the new day, this day has become the previous day, right? So the liquidities that are present in this day are previous day's liquidity. So what is meant by the first liquidity? Previous day's external liquidity means previous day's highs or lows. What is the low of this day? The low of this day is here. This is the previous day's low, and this is the previous day's high. The previous day's lows and previous day's highs are very, very high probable reversal points. For example, in this day, if the market took the high, there is a very, very high chance that the market is going to reverse because the liquidity is taken out, because lot of retail people will have their stop losses here. So the market maker will hit these stops and it will move in the real direction. So then what is the meaning of previous day's internal liquidity? The second most important liquidity. You will see lot of reversals using this liquidity, because lot of the smart money people will place their order blocks or blah 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 stuff liquidity here, because lot of retail people and smart money people will think the market is moving from the order blocks and support and resistance and anything, because they don't know how the real mechanics of the market works. I am using these concepts from the past 5 years. I keep on refining by collecting data. You are directly accessing to my 5 years of data in this video. So watch this video till the end. So here, liquidity got taken out. Again, the liquidity got built up. Again, resweep and it gone. Simple. This is how the market moves from the liquidity point to the liquidity. So this is the previous day's internal liquidity. And also this is previous day's internal liquidity. After the previous day's internal liquidities are taken out, the market is going to reverse. So this is the basic understanding of the first two types of liquidities: previous day external liquidity and previous day internal liquidity. So let's talk about what is the meaning of the structural liquidity. It is one of the very important liquidity. So normally the market moves like this, right? Many order block traders and the supported resistance traders will think there is a order block for every move. There is a order block for every move. No, sometimes this is not the correct structure of the market. The market will move however it want. The market will move however it want. There is no clear rule that it should come to the 50% and move. It will move however it want. So always, if you see, there is a liquidity responsible for the continuation of the trade. There is a liquidity responsible for the continuation of the trade, because if you see in the, let's assume this is the 15 minutes time frame, right? Let's assume this is the 15 minutes time frame. If you see the 1 minute time frame, the 1 minute time frame will look like this, because the time and price is completely fractal. If you observe here clearly, the market took this liquidity here, the market took the liquidity and it move up. Same thing here. So without the liquidity, there is no movement. Many people think the reason is order block for the movement. It's not. The liquidity is responsible for the move. So this is the basic understanding of the structural liquidity. So for every move, there should be liquidity here. There will be liquidity in the lower time frames. That liquidity is taken out and the continuation came. Same here. There should be a liquidity here, like the price action here. I will draw here. See, it should be like this in the lower time frame, and it will take this liquidity like this, and it will move up. The same pattern happened here. So this is why the structural liquidity is very important, and it contributes towards the structure of the market. So this is very important. And the fourth important liquidity is transactional liquidity, because I will draw here. The market never move in a straight line like this, or the market never move in a downward trend like this. It should contain higher highs and higher lows, or lower lows or lower highs. See here, the market moves like this, right? Because after every high is taken out, there should be a pullback, because this is liquidity. Every high and low, every clean high and low in the market is liquidity, right? So that's why it needs a pullback. Otherwise the market won't function, because the market makers, if you want to buy, they should sell. Here, if you want to buy, they should sell lot of positions to you. For example, to explain clear, if you take a position, buy position of 10 lots in the GBP/USD, the person who is selling you the 10 lots is the market maker. If you keep on buying the positions here and the market went up, the market maker's positions will be in the huge loss. His sell positions will be in the huge loss. So the market makers, what they will do, they will come back and mitigate their losses in the break even, and then they will move in the real direction. This is why always there should be a pullback in the marketplace. Otherwise the market won't function. This type of stuff you can't find anywhere in the YouTube. I have paid thousands of dollars to the mentorships and learned from many of the great traders. This is all the mechanics of the market. This is why the pullbacks occur. This is the reason why the price never goes in a real direction. Simple reasons. You should understand this. These are very important. So this is the transactional liquidity. So let's learn about the inducement liquidity. For example, normally many smart money people will think the market will always go like this. It's completely wrong. The market never moves like this, because if the market is moving like this, everybody would trade and everybody would be millionaires. So the market needs liquidity to fund the price, to fund the moves. If the market is moving like this, the market makers will go broke. Simple thing. If you understand the common sense, they will looking for us liquidity. So a lot of stop loss will be here, and it will move in the real direction. It will follow the structure. The market makers follow one direction, but while going there, the behavior will be like this. The price behavior and the price direction are very different. If the market makers wanna move the price from here point A to the point B, the price behavior will be like this. The price never move like this, because the markets won't function like this. This is the simple reason. This is why inducement liquidity is very important. If you understand all these liquidities, like my students, you can literally enjoy the markets, enjoy the profits in the markets every day. You should just wait for the liquidities to be taken out and wait for the 99% of the trade, the stop losses to be taken out, and just enter the trade. This is how easy it will become trading. And also, let's talk about the news highs and news lows. Majority of the news wicks are used as the liquidity in the marketplace, whether it may be the FOMC or it may be the NFP or anything. It is used as the liquidity in the marketplace. And also the daily liquidity, same thing. It's like the also structure, but in the daily time frame. Every high and low, every clean high and low in the daily time frame is used as the liquidity. This is very important. For example, if this is the daily liquidity, let's say if the market took this liquidity, the 15 minutes would be like this. If the 15 minutes presented this setup, I will just sell here. My stop loss will be around 3 to 2 pips. I will just target this. Simple, it will give lot of RRs. You can easily get 40 to 50 RRs in this type of high quality setups. We are just identifying the high quality liquidities in the marketplace. This is the very simplified version of the liquidities I can explain to you guys. Just don't sleep on this. This is very important. A guy in the YouTube last week just messaged me by watching my YouTube videos. He understood liquidity and he created his own concepts and entry patterns using my concepts he learned in the YouTube, and he's profitable now. He passed 2 phases of the 10K account in a single week and just messaged me that using your concepts I made money. So always the difference between that guy and the people who are watching the video like you, they are putting the work simple. If you also put 8 to 10 hours of backtesting every day, you will also become this test. Just watch my YouTube videos and do the backtesting, simple thing, because I am sharing all the hidden knowledge which is not available in the YouTube right now. Simple, follow these steps and become profitable. If you see, I will explain now why I took these 3 trades using the liquidity concept just I have shared you here. The first trade I took is here. This is the previous day's high liquidity I explained you. This is the first type of liquidity I explained you, right? Previous day's external liquidities. Previous day external liquidities means previous day highs and previous day low. Simple thing. I entered exactly here, and also there is a small confluence is there for us. There is a clear range. Range indicates the smart money is building up the money. Range is there for the confluence, liquidity is there. I just entered after the engulfing candle. Stops above the candle high, targeted next liquidity, previous day low. This is the whole retail buildup. Retail people are trapping so many times. All the liquidity got taken out. We made our 7% gain. Simple, just one trade per the day and we made 7%. And you should know, because many newbie liquidity traders, they don't know. They think we should trade every day. But if the liquidity is not clear, you should not trade. As I have a lot of experience in the marketplace, I'm telling you, you should not trade every day if you use the liquidity concept, because some days are used for the building up of the liquidity. This day is whole accumulation of the liquidity, and this day took that accumulation and focused on the real move. So by the experience, you will understand which inducements to avoid and which inducements to take. My students exactly know and avoided this day. We took this sell, we took this buy, avoided this day successfully, because this is the accumulation phase of the market makers, because the market makers need liquidity. If the liquidity is run out, because the previous day it took 2 times the liquidity, so the pot is empty. They should fill the pot with the money. The retailers should come to fill the pot with the retailers. They should print the chart patterns that make the retail people interested in keeping the positions. To make the retail people interested, they will print some chart patterns like double tops and double bottoms, blah blah blah. They will print some chart patterns, and after seeing these chart patterns, the retail people will put the money in the marketplace. They will be interested in the marketplace and they will buy. So that's why their stop loss got hit and it will be reversed. So this sell, same thing. This is the Asian high plus the retail buildup. Retail buildup was taken out with a huge speed and aggression candles. Reversal candle, I entered the trade, targeted the next liquidity. This is the previous day's external liquidity, which I have just explained you. Simple. And also, this is the Asian low that was taken out in the time of the kill zone. This is the New York kill zone. This was taken out in the time of the kill zone. I entered at the rejection candle, targeted the next liquidity. So this is how the simple trading will be. Many people are overcomplicating and they are not profitable. They are switching from one strategy to the another strategy, one edge to the another edge, and that's the main reason they are never profitable in the marketplace. To trade, you should just need a simple edge. My edge is backed up with the 4 years of data, and every student is profitable right now who kept the work. So this is the main reason lot of people are unprofitable. Many mentors who are teaching you don't have a proven edge. They don't have backtested proof that their edge is profitable. Whereas my edge has 4 years of backtesting data and it produces some amazing wonder results. No edge in the industry is near to this accuracy of this edge, because we are operating very near to the mechanics of the market. This is how the real market works, how the market makers execute, how the market maker operates. So this is why the market making happens. Everything is liquidity in the marketplace. So just don't sleep on this liquidity. This is very important concepts. So if you find this video helpful, just like and subscribe. And also if you want to join my one-on-one mentorship and need my one-on-one guidance, my WhatsApp number is in the description. You can just send a hi so that we can set up everything. Peace, guys.